Tom Lee with Fundstrat said today, "We think an inline April CPI next week will highlight the possibility that auto insurance disproportionate impact on CPI is abating. Could push higher the number of Fed cuts, equals positive for stocks. Bottom line, we are still buy in May. The fact that stocks rose this week is a positive signal." While I agree with Tom Lee and Fundstrat, next week's CPI report is going to be very important and probably show progress on getting inflation to go lower. The data that we got today makes you really wonder if we're heading into a recession after all. Today we got Michigan consumer sentiment. We were expecting this would actually go up from 77.2 last month to 78. This number came in at 67.4. That was an 11-point miss. That is huge. Michigan consumer expectations came in at 66.5. The expectation was 77.3. Last month, the number was 76. A huge miss there as well. Michigan current conditions came in at 68.8. Last month, you were at 60 or 79. So this was about a 10-point miss as well here. The expectation was actually a rise to 79.5. Ouch. Wow, that's just terrible numbers. Now, this is the preliminary numbers, so there's going to be some final numbers that come out, some revisions, if you will. But holy moly, those are nasty. Bad news today as well in this data. You had 5-year inflation expectations that came in at 3.1%. Expectation was 3%. And 1-year inflation expectations that came in at 3.5%. The expectation was a drop from 3.2% last month to 3.1%. So rising inflation expectations with a consumer that does not feel good about the economy at all, bringing up a little bit of those stagflationary concerns today. And that is why you are seeing the Russell 2000 that is down almost 1% today. The NASDAQ is down about 0.2%. S&P is up 0.18%. And the Dow is up about 0.3% today. The leading main article here on CNBC says consumer sentiment tumbles as inflation fears surge. This is bad news for the Fed today. But I'm more convinced now than ever the Fed is asleep at the wheel. Because yes, at the same time inflation expectations rose, the consumer is feeling like utter dog crap. Okay? That's typically a sign that spending is slowing down big time and just an overall bad sign for the economy. This follows ISM services plummeting, the LEI business activity index plummeting. This follows a unemployment rate that just went up that missed expectations, as well as a non-farm payrolls report last week that came in over 60,000 jobs weaker than expected, among other negative signs for the economy. Like Walmart, Target, Dollar General, Coca-Cola, Newell, among other companies that are warning the consumer is starting to quote-unquote crack. Perhaps the Fed forgot just how fast the economy can weaken. Take a look back at September 29th, 2007. This headliner from the New York Times reads, "Consumer spending rises, easing fears of a slowdown." Consumer spending rose more than expected in August, while a key inflation indicator cooled. Personal spending rose a better than forecast 0.6% last month, the largest uptick since April of 2007. So that was September 29th, 2007. By November 8th, 2007, Bernanke warns Congress of an economic slowdown. 5 weeks later, the Jerome Powell of 2007, Ben Bernanke, was warning Congress things are about to get bad. Then what happened? By January 14th, 2008, a couple weeks later, here's the headliner. Americans cut back sharply on spending. Strong evidence is emerging that consumer spending is faltering. And a lot of this decline in personal spending back in 2007, 2008 was blamed on higher energy prices, which sounds kind of like what we see today, but besides in energy, it's in everything. Now, I'm not saying now is time to head for the hills to sell everything and get super bearish. No, not exactly. I think right now is a good time to raise some cash, to be a little bit more defensive, especially if you're investing in the broader markets. The real question is now, not are we going into a slowdown? We're definitely going into a slowdown, that's for sure. The real question is, though, can the Fed thread the needle between slight economic weakening and rate cuts? Or are they going to be asleep at the wheel for too long and cause too much economic pain? Well, to be honest with you guys, I have the least bit of confidence in the Fed than I have ever had before. And I think that says a lot because the Fed was way too late to start raising rates. Here's what Fed officials said today. Fed Bowman said, we need to keep policies steady for a bit longer. Okay, fine. Fed Logan said, there are uncertainties if policy is sufficiently restrictive. Are you kidding me? At a time in which the economy starting to slow down in a meaningful way, like it's actually starting to show up in the data, we're having conversations about, are rates high enough? Let me just tell you guys how things operate, okay? By the time you actually see the economy slowing down in the data, it is far too late. Because data tends to be very much a lagging indicator of what's actually going on out there. Fed Logan goes on to say it's too early to think about cutting rates, and Fed Logan says the strong economy could be a sign of higher neutral rates. So again, throwing doubt out there that rates are high enough. Now, again, does this mean markets need to crash from here? Absolutely not. I do think this means you want to be a little bit more careful, maybe a little bit more defensive in your overall positioning in our markets. And I've talked about this many times before. I do not like the NASDAQ or the S&P on a headline basis where we are today. You're not priced for a consumer slowdown. You're not priced for any kind of recessionary environment. You are priced for absolute perfection. There is no discount in stocks on a S&P or NASDAQ headline basis right now. There's just not, okay? None. Nada. No discount. No deals out there. But if you look under the surface, there are stocks that have gotten destroyed, like PayPal, Fubo, SoFi, Tesla, that are stocks that I personally own that will benefit from rates going lower. It will be a balance, though, between some weakening in the economy and rate cuts. Also, inflation falling. So inflation, economy, and the Fed, it's going to have a big impact on the small cap, interest rate sensitive sector of our markets. And this is where I am in agreement with Tom Lee. Tom Lee is not super bullish about the S&P or NASDAQ on a headline basis, but small caps and interest rate sensitive stocks could do very well. Now, also as Tom Lee has pointed out on his X account, I recommend you give Tom Lee a follow over there. Commodity prices falling like oil are going to have a very positive impact to CPI. So preferably inflation starts to plummet, giving the Fed a reason to start cutting rates before the economy weakens too much. That's the bullish outlook here. Now, ever since the start of 2024, oil went from, $65 a barrel to 83 and a half. No wonder inflation has been ramping up in 2024. But since April 12th, and really since the start of April, oil has went from about $83.41 at the high, down to where you are today at $75.42 per barrel. You've actually seen some disinflation in the oil markets in April and now in May. That should be good for next week's CPI report. That should be good, at least if this continues, for May's CPI report as well. Oil is down about 1.5% on the day today. Now, coming next week on Monday, you're going to get Fed Jefferson that speaks, as well as Fed Mester that speaks at 9 o'clock in the morning for both of them. On Tuesday, you're going to get PPI month over month. That's expected to come in at 0.2% for the headline and for the core. But take a look at that. 10 o'clock in the morning, you get a speech from Fed Jerome Powell. Now, judging off of what Fed officials said today, Jerome Powell might be pretty hawkish coming next week. Although if you look at the data that came out today with the Michigan Consumer Sentiment Survey, you would say, oh, whoa, something just cracked in the consumer. Now, who knows? Tuesday could be a big day next week. Wednesday is going to be an even bigger day, most likely. You will get core CPI month over month, expecting that to come in at 0.3%. 0.3% or better could raise the amount of cuts that the markets are expecting. Now, what's interesting as well about Wednesday is you also get retail sales. So retail sales month over month for the month of April are expected at 0.4%. Last month's number for March came in at positive 0.7%. So that would be a step down as well. It wouldn't surprise me if retail sales actually come in negative, because when you're, again, looking at a month over month number and you're coming off a 0.7% number, you know, on a month over month basis, 0.4% is still pretty dang strong. Wouldn't surprise me if that number comes in weak. It wouldn't surprise me if inflation numbers come in weak. That could be a very good recipe for stocks coming next week. Markets currently have a 74.6% chance of a cut coming July 31st. My expectation is we will get the first rate cut coming July 31st because I think things are going to weaken from here, but I don't think they're going to be, full-blown recessionary by July. Okay, it's possible. I mean, July 31st is almost August, and we're going to have quite a few different data points coming out from now until July 31st, like 2 or 3 of everything, right? CPI reports, retail sales. We'll get more GDP numbers, all kinds of different things will be coming out from now until July 31st. But I do believe the markets are going to start to expect the first cut July, and I think that can be really bullish for small caps and your interest rate sensitive areas of our markets. It wouldn't surprise me if things do really start to weaken by September and we get another cut in September. So that's 2 cuts this year. And then depending on where things are as far as the economy and inflation, you could get another cut in November and a cut in December. So realistically, you could actually look at 4 cuts this year if the economy is truly starting to weaken. I think a better base case scenario is 3 cuts. But I don't think 4 cuts is that far-fetched. I would say like 35% chance of 4 cuts this year. Judging off of recent economic data that we have seen, it's come in really bad. Which, again, as long as we do avoid a recession and everyone doesn't pile into their recession camp again, which I don't think they're going to do after it's been so long and so many people have been wrong about predicting a recession. As long as that doesn't happen, then I think stocks, specifically interest rate sensitive, small caps, will do better here over the next coming months. Tom Lee writes on X about 50 minutes ago, rising gasoline influencing University of Michigan's consumer inflation survey 1 year ahead expected inflation up to 3.5% historically follows gasoline prices, which is very true, right? Look at gasoline. It's risen recently, and so has inflation expectations, which does make a lot of sense, right? That's where a lot of people look at, especially to monitor what inflation is doing. The biggest thing you feel each and every single day is when you go and get gas. If you're like, dang, gas is up 20 cents in 2 days, then yeah, you're probably going to expect, greater levels of inflation ahead. So that's not a huge shocker. Fundstrat and Tom Lee as well say here, April CPI next week could increase markets' expectations for Fed cuts back to 2 or 2.5 cuts from 1.8. S&P 500 1.7% positive week to date. A reminder to never short a dull market. The most important is April CPI. coming on May 15th, next Wednesday. And even if the report matches consensus of positive 0.331% month over month, we expect this to be positive for stocks. So Tom Lee is saying, even if we get a consensus view for inflation, that likely means markets will price in more rate cuts from the Fed, let alone if inflation comes in lighter than expected. Here on the day today, the Fear and Greed Index over on CNN Business is back to neutral at 48. Yesterday, you were in fear territory at 44, so that definitely looks a little bit better today. The percent of stocks above their 50-day moving average getting whacked today, especially with the drop in small caps. About 2.25% of stocks are breaking under their 50-day moving average. Now you have 53.5% of stocks that are currently above that 50-day moving average. If you take a look at StockTwits over here on the S&P 500, the SPY ticker symbol, sentiment is extremely bearish today at 23. Yesterday, you were bearish at 42. So it seems like people have started to flip, and they are starting to get a little bit more cautious about where markets are at right now. The latest AI investor sentiment survey, which came out 2 days ago, is also pretty interesting. 40.8% of investors are bullish right now. But take a look at neutral. Neutral is now at almost a one-year high at 35.4%. So 35.4% of investors are neutral right now. That's a huge number. 23.8% of investors are bearish. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a fantastic rest of your day, and I will see you in the next one.